What is going on, guys? Can you Hey guys, what's going on? Let me pop out the chat real quick. All right. As probably most suspected, the inflation data came in a lot hotter than expected. Actually, it didn't even need to come in that much hotter than expected. Let me look at the chat real quick. Say good morning to some of you. Richard McGuire, what's going on? Ryan, what's going on? Richard Scott, Hermer, Aditya, what's going on, guys? Actually, you know what? Sonar, what's going on? Harry, let me actually announce this real quick in the Discord. But as expected, inflation data came out 5:30 a.m. Pacific time, 8:30 a.m. Eastern time, and the inflation data came in hotter than expected. Now, it didn't even have to come in that much hotter than expected. And we'll go over what was expected versus what came in. But what was expected was 8.1% year over year, and we came in at 8.2% year over year. Luckily, we had puts. We also had a strangle, both of which worked out because we got a huge move this morning. So let me put this in the chat real quick. 1 second. 1 second. Thank you for your patience. 1 second. Okay. So we actually had a strangle. We had puts. We still have, well, I still have puts open on the QQQs. I still have SPY puts open. And then we also have a put spread on Apple, which is up nicely today. Now, it doesn't, bring me joy to see stocks go down. However, it does bring me joy to know that, at least we can be equipped with the tools to learn how to play each direction. I mean, if all you know how to do is sit on your hands, then buy stocks and sit on your hands, and you're probably assed out, and it's not a good feeling. And it's probably best that you try to sharpen your skills as soon as possible because there is an alternative, right? Um, all right, so let's go over this CPI report and then I'll take your questions and your comments. Well, you know what? I should post this on Twitter too. Live now to talk about inflation and CPI. All right. So the CPI report came in at 8.2% year over year. Economists were expecting 8.1%, but it sounds paltry, right? It only came in 0.1% higher, but that's enough to signal to the market that inflation is not going anywhere and that the Fed actually has to push with rate hikes, be more aggressive with monetary policy, especially since the unemployment report came out very strong, which is what we didn't want. So back to back pieces of data that the Fed is going to rely on to determine whether they're going to hike aggressively or not is the unemployment report, showing that unemployment actually is going down, which is against what the Fed needs at the moment. And then the CPI showing that inflation is going up. Now, I also posted something yesterday on Twitter, showing what was it? It was the correlation between the PCE and the CPI, or sorry, PPI and CPI. So PPI came out yesterday and CPI came out today, but there's almost 100% correlation with PPI, and PPI came in with an above expected increase of 0.4% versus 0.2%. And for most of 2022, if you look at this chart, PPI and CPI have been highly correlated at almost 100%. So gave us a signal to on how to actually play the CPI. So I'll go over the plays in a second, but let's just finish going over this report, and I'll take your questions too. So be sure to post them in there. The U.S. Bureau of Labor Statistics said Thursday that inflation measured by Consumer Price Index rose 0.4%. So economists were expecting 0.3%. It came in higher. Core CPI, which excludes energy and food prices, climbed a sharp 0.6%. So even if you remove the two most volatile commodities, food and energy, we still came in above month over month. And this is September, right? So if you remember in September, this is when prices of a lot of things, of a lot of commodities, have already dropped. So imagine what October is going to look like after prices increased. Because in September, I'm looking at crude oil futures here. In September, crude oil futures, or the price of crude oil per barrel dropped 11%. Excuse me. And that was in September. So imagine in October when crude oil prices have now risen by at least 5%, even though it's dropping a little bit. But in October, it's risen by 5% since September. So yeah, I mean, it's not looking good for October. And all this means is that the Fed is going to have to hike aggressively come November 2nd. So remember, November 2nd is when the next Fed meeting is. So in terms of the indices, we now see that the S&P 500 is down 1.2%, was down a lot more. NASDAQ is down 2%, and the Dow Jones is down 0.9%. Now, this is likely going to be volatile all day, but I don't think that, like, even if we were down a lot more today and then came back up a little bit after market open, I do think it's going to be choppy and it's going to continue to go down, because evidently what happens here is that if you look at the weekly levels on the NASDAQ, for instance, right? Let me just pull up the weekly and let me pull up the moving averages. You'll see that we are currently well below the 200-week moving average. So we were hovering above this, or around this, sorry, for a couple of weeks. And if we were going to have a turnaround, it was going to be at that point, right? But it was data dependent. So, this is where technicals and fundamentals come hand in hand, because if we were going to have a turnaround, it would be at the 200-week moving average. Say that unemployment came in higher and CPI came in lower, then we would have bounced from here. But as we've been stating over and over again, if unemployment comes in lower and CPI comes in higher, we will start the next leg down, and we will actually be targeting the pre-COVID highs on the NASDAQ or the QQQs. That's around 237, and on the SPY, the pre-COVID highs is around 340. But yeah, even the S&P 500 now is below the 200-week, which is something that, aside from the COVID crash, it's something that we've stayed above since 2011. So we're talking about 11 years, right? And even if you look at previous drawdowns, the 200-week is where we stopped. But let me get to your questions and I'll go over the plays. All right. Barry, what's going on? Ian, sorry, Anthony, Tim, Arturin. Can we hit 40 on the VIX yet so I can buy? Yeah, I mean, that if you're waiting for the VIX to hit 40 to buy, I mean, that's historically that's when you actually want to buy stocks, is when the VIX is above 40, because that's the capitulation level, right? All right, let's see. You down with UUP? Yeah, Regine, what's going on? TECS. I don't even know. Oh my God. What? Rum Shaker. Jesus. Hit the likes. Yes, guys, if you're on the stream, hit the likes. What do you think will look Q3 earnings for companies? Marvin says. Okay, so this is the next thing to watch out for before the Fed meeting on November 2nd, which right now, if you look at the Fed watch tool, almost 100% certain that, well, actually, let's refresh it. If you look at the Fed watch tool, let's see what they're betting for the Fed rate hikes on November 2nd. Yeah. So you can see here that a target rate of or a 75 to 100 basis point rate hike is coming in at almost 96%, right? And now there's even a higher bet that we get 100 to 125 basis points. That's at 4.2%. This is a new plot that just popped up, right? This wasn't here yesterday. If you look at this this bet right here of 100 to 125 basis points, yesterday we were at 0. Today we're at 4.2, right? And yesterday the 50 to 75 basis points was at 15.5% chance. Currently it's at 0. So for sure the Fed's going to do another 75 to 100. They may even just rip the Band-Aid off this time and go 100, which, I mean, again, we discuss this time and time again. There hasn't been enough time to see what the rate hikes are going to do. So it's evident that the Fed is rushing to gain any credibility back that they had, and they will likely break the system in the process, because too many rate hikes in a row without pausing and seeing the effects of those rate hikes is very detrimental and will cause a hard landing, right? It's all going to come crashing down at the same time. But right now it's just built up, and we haven't really seen the effects of these rate hikes. And the more that these numbers come in unfavorably, the more that the Fed is going to use this blunt tool. But the problem is the blunt tool needs a lot of time to work, and they're not going to give it time to work because they're impatient. Do you think DCA Soxel is a good idea? If you're willing to hold through volatility, then yeah. But just know that when it comes to 3x leveraged ETFs, you're going to also have disproportionate losses when the underlying drops. So when SOXX drops, the Soxel ETF is going to drop disproportionately. So do I think it's good? I mean, I think that there's no rush here. There's no rush. I mean, we just breached the 200-week moving average on the triple Qs, and on the S&P 500. To me, there's no rush because it's evident that we're going to get to that, 238 level. So, yeah. All right. In terms of the plays that we had, okay. So, like I said, we had here. I can actually. We can actually go over them, but we had a strangle on the triple Qs, an uneven strangle or a broken strangle, but basically slated towards the put side, right? So 2 puts for every 1 call. The 258, 270 put. We also the 258 put, the 270 call. We also had the, let me see. I also bought the 355 put on the SPY. And then I also had, in preparation for the next drawdown, I bought the 135, 130 put spread on Apple as well. So, again, sharpening your tools, making sure you have enough tools in your toolbox to play moments like this, I think is vital. Otherwise, you're just going to wait for your stocks to be up. And it's going to be painful. Now, in terms of how long this is going to last, it really depends on inflation. Like if we look at history of Fed rate hikes, if you look at the history of inflation and rate hikes, this stuff is really sticky. And as I was saying before, This period isn't really comparable to 2008 or 2000. I know that people like to pull up charts of 2000 and 2008 and say, "Oh, this is the same thing." No, in this case, we know well ahead of time that a recession is coming, which actually makes, if you're if you know that a recession is coming, if you know that a stock market crash is coming, and you don't position yourself with plays day in and day out, or at least don't take the time, this time to learn how to play both ends of the market, then you're really selling yourself short, because 2008, we didn't know a recession was coming. Yes, there were a few people flashing warning signs about being over leveraged in the mortgage backed security space, but in terms of the masses, right? Everything was fine and well. Nobody thought that we'd be on the verge of the worst recession since the Great Depression. In 2000, same thing. Everyone knew that in 2000 that we were in a stock market bubble, but nobody was anticipating a huge recession. In this case, the Fed is telling us that they're trying to break the system and cause a recession. So, if you don't know how to play both sides of the market, if you don't know how to play a down market, a neutral market, if you don't know how to hedge using a strangle, a 2-to-1 strangle at that, where, you are still giving yourself a chance to play the upside if the CPI data somehow unexpectedly comes in lower, but you're most likely skewed towards the downside. If you don't know how to do any of this stuff, and you're not taking the time to learn, when the Fed is giving you months and months and months of a heads up saying, we are trying to cause a recession, we just hope that it's a soft one, which is the term soft landing, right? The term that they love using. They're telling you that they're trying to break the system. So, yeah. All right. So this is what I was saying, is this is more analogous to 1980, not 2008 or 2000. In 1980, we had crazy inflation. Inflation was 13.5%, right? And a lot of people will argue that we're closer to that type of inflation than 8.2% or whatever. But either way, inflation was 13.5%, and the Fed had to keep pushing the rate higher. 15%. We raised the Fed funds rate to 15%, 20%. Paul Volcker was a gangster, y'all. May 15th, 1980, they started dropping the rates once again because the recession had ended. But inflation was still 12.9%. So they prematurely dropped the rates, right? The recession had technically ended because GDP was going up. However, inflation was still crazy. So the Fed then had to come back in and say, fuck, we did this too early. We pulled out too early. No pun intended. 10%, 11%, 12%, 18%, back to 20% that same year. So in March, they were at 20%. Then by December, they went back to 20%. It wasn't until then that inflation, even though it was still double digits in 81, finally started coming down significantly, right? We had a 20% drop in inflation here. The Fed funds rate stayed at 20% all the way until May. And then finally, when inflation in 1982, so it took 2 years, when inflation was 6.2%, half of what it was in 1980, then the Fed started easing, even though keeping the Fed funds rate really high. By the way, people that are old enough or your parents that are old enough that have bought houses in 1980, ask them what their mortgage rate was, right? People now are reeling over a 7% mortgage rate. Ask anyone who bought a house in 1980, 1981, 1982 what their mortgage rate was. It was in the double digits. And ask anyone who was alive at that time what yield they got in their savings account. It was crazy. So it took 3 years it took 2 years for inflation to come back down to single digits, and then the following year it finally came down to 3.2%. And it hovered around that 3-4% range until 1986, when inflation finally hit the Fed's target rate of 1.9%. So it takes a long time for inflation to come down, and the system has to break. Both the economy has to break, meaning that the Fed has to force unemployment higher, and the stock market has to break, right? And more importantly, the bond market, which is much bigger than the stock market, has to break. So, unfortunately, inflation is very, very sticky and will be around for, well into 2023, I think. It doesn't mean that we can't have positive GDP growth, and it doesn't mean that the stock market won't find a bottom in 2023. I think, by the end of 2023, we'll have a bottom an actual bottom in the stock market, because that's when the Fed will likely stop hiking. I don't know that they pivot, being that inflation is this sticky now. I don't know that the Fed pivots, meaning I don't think that they reverse course and cut interest rates, but pausing to see what happens is a high likelihood in 2023 for sure. And in my view, was a high likelihood in November if inflation came in lower and unemployment came in higher. So, Roman, thank you. Oh my God, thank you so much for donating $50 to St. Jude's. Yeah, guys, go ahead and hit that. I always forget to say it because I'm just assuming that people are doing it, but hit that donate button. If you are thinking of giving me any super chats or donations or whatever, instead hit the donate button and send it to St. Jude's instead. They can use the money a lot more than I can. God knows that. So be sure to do that. And thank you so much, Roman, for your $50 donation. That is very generous of you. Appreciate you, man. Roman's always donating, by the way. So thank you. All right. More 8% of 500K. Not sure what you're talking about. 17% of 30K versus 8% of 200K. Oh, I see what you're saying. In terms of home prices, yeah, but when you look at nominal dollar figures, it doesn't matter. A $30,000 house in 1980, if you adjust for inflation, is hundreds of thousands of dollars now. So it's instead of looking at the nominal number, you have to look at the relative number. Also, wages were a lot lower in 1980, right, versus now. Ask anybody that works in Silicon Valley, right? I mean, you can easily get, if especially if you're skilled at, something like software engineering, you can get a $200,000 job. Out of college, you can get a six-figure job. And yeah, my first job out of college, I think I was paid 32,000 a year. Which is why I went the software route, right? Because I looked at all my friends that majored in computer science, and they were signing contracts like NBA players, right? Microsoft, Google, Apple, like they were hiring like crazy, throwing packages at them, giving them signing bonuses like they were LeBron James or whatever. So that's the reason that I moved from finance immediately to software, because the money was so much better. And although I love finance as an academic subject, I was going to be stuck in the hamster wheel for quite a while before I made any serious money that my friends were making in software. So anyway, went off on a tangent there. Richard McGuire, thank you so much for your donation, brother. Thank you. Keep the mic closer to your mouth. I can't hear. Really? Does anyone else have this problem? Let me see. Let me check the levels on the mic. It looks good. It looks good. Maybe you should turn up your volume. I think the mic looks good. I mean, the levels are almost hitting red. All right. Let's go through questions. Inflation was the current Democrats' greatest accomplishment. Fred Eric says, inflation has run hot under both parties. I mean, I think, this is why I remain very cynical of the U.S. political system, is because over time, it's shown that both of them work for the same corporatocracy, right? Um, and if you remember, inflation, certainly this round of inflation, the Democrats definitely did try and rush even more stimulus packages through Congress. Luckily, the last round of them was shut down because that would have created an even more inflationary scenario. But a lot of the initial stimulus was under Trump. It wasn't under Biden. So it started under Trump and continued under Biden. Now, did it need to continue? No, I think that we had enough stimulus in 2020, um, that we definitely didn't need more later on. And I think that the stimulus was also mismanaged. I know this because I was getting calls from what is it, from the Bureau of Labor, or was it, I can't remember, whatever the official federal bureau was that oversees small businesses. I was getting calls to accept, PPP loans, even PPP grants. And I remember turning them down because I'm like, give it to someone who runs a restaurant, give it to somebody who, has a mom and pop electronics store, that you forced to shut down, right? But it was mismanaged. I mean, you hear of all these stories of celebrities getting PPP loans and accepting them, whether it's Joel Osteen, whether it's Kanye West. There were so many people that got PPP loans during COVID that it was so mismanaged. You're like, where is this money coming from, and where is it going, and why is it going there, right? Yeah, in my view, it was so easy to pinpoint who owned a struggling business and then give them that money. Instead, they printed the money first and then scrambled to spend it later, which is, to me, a high crime, right? But yeah, certainly inflationary policies continued under the current Democratic administration. But don't forget that the initial rounds of stimulus happened under Trump. So both parties are to blame, as always, right? I mean, when you look at I just went over the history of of inflation, and both parties were in leadership when inflation was going crazy, right? It took a gangster like Paul Volcker to come in and cut rates. And even though the chair Fed, or not cut rates, sorry, raise rates to 20%, and even though the Fed is supposed to be neutral in terms of his or her political affiliations, the Fed chairs, their parties are on record, like the parties that they are in or that they vote within are on record. So not that it matters, but I believe Jerome Powell is a Republican, and I think Paul Volcker was as well. So it's not red or blue. I mean, don't get caught up in the hysteria of rooting for your team. They both make mistakes. Like Paul Volcker came in and raised rates at 20%. Jerome Powell, who's also a Republican, told you that that inflation was transitory and didn't do shit in 2021, and now is playing backup and is going to crash the economy. He's a Republican. Joe Biden is a Democrat. Tried to push through crazy inflationary policies for above and beyond the stimulus package that or the first round of stimulus that Donald Trump pushed through, and Donald Trump is a Republican. So getting caught up in this red versus blue as opposed to looking at actual policies, and critiquing those who implement those policies, whether Democrat or Republican, that's short-sighted in my opinion. Each person who has control over some sort of monetary policy, I don't care what party they are, they're not beyond criticism, right? So, all right. President Carter appointed Volcker. Yeah, exactly. And President Carter was a Democrat, right? So, there you go. And Jerome Powell was appointed by Trump and reaffirmed by Biden. So again, Republican Democrat appointing a Republican Fed chair. There is no, there isn't really any sort of truth to this partisan inflationary story that some people are I think ignorantly trying to push through. All right. You good, Z? Oh, you're talking about the sound. Yeah. Hi. Yeah, I live in San Jose, California. I'm not sure what. Oh, Silicon Valley is the shit. Yeah, I mean, for those that that are lucky enough to get jobs in Silicon Valley, yeah. Do you recommend to cut losses now before the end of your sell-off? Eric, my man, if you were going to cut losses, you should have done this a long time ago. I mean, we had a ton of warning signs. I think now it's too late. But the fact that you're asking this, if enough people do this, right, it'll be called capitulation. And that is essentially when the market bottom will be in, is when enough people sell at the bottom, right? But for those of you that are thinking, or for people that are thinking of selling at the bottom, just think of who are you selling to, right? Um, who are you selling your stocks to if you're thinking of selling now? Because there has to be a buyer, right, to pick up your shares if you're selling. So if you're going to be selling at the bottom, who are you selling to? You're going to be selling to someone who's willing to buy your shares. That is the person that you need to be when it comes to investing, right? Not someone who bought at the top and who's selling now or bought near the top, but someone who's willing to buy the crumbs that people are letting go of when they capitulate. That's the person that you need to be, when you continue your investing journey through life. You need to be the person that's willing to buy. Like if we hit these pre-COVID highs here, right? And then you're going to get a huge round of capitulation here because these prices are the prices of stocks here are going to be too low for some people to bear, and people will start thinking like you and saying, "Shit, I'm just gonna let go of my shares. This is too much loss for me," right? Who's going to be picking up your shares there? Who's going to be picking up your shares there? That's the person that you need to be. It looks like we are, we're only less than an hour into market open, and it looks like we are recovering a bit. So the Nasdaq was down 3% this morning, down 1.6% now. Hopefully you guys closed your strangles. For those of you that are part of the academy, hopefully you closed your strangles, because that big move down, that 3% move down, is essentially what you wanted, right? And now it looks like we're recovering a bit, but I don't believe any part of this recovery. I mean, the news that came out this morning, for me, I think it's pretty clear we're going back to pre-COVID highs, in my view, right? Because think about it. You have the Fed coming in February 2nd. Now they're likely going to do a 75 to 100 basis point rate hike, the fourth in a row. This is the most aggressive the Fed has been since 1980. Actually, in 1980, I don't think we've even gotten back to back rate hikes. And certainly not 475 basis points, and maybe could be 100 this time in a row, right? Because we did 25, 50, 75, 75, 75. That's 5 hikes in a row. And then another 75 or 100 will be 6, and it'll be the fourth at least 75 basis point rate hike in a row. So, in my view, I think these pre-COVID highs here are inevitable. Now, especially if, let's look at some of the earnings coming out, especially if these earnings coming out are going to be disappointing, right? So like Apple reports earnings October 27th, Microsoft, and I'm just going to be taking like the biggest companies in the S&P and in the NASDAQ. October 25th, Tesla reports on October 19th, Amazon reports on, so this is upcoming October 27th. So they all report before the end of the month. If these companies come in with worse guidance, worse than expected earnings, that is going to rapidly accelerate the next leg down. So imagine we have earnings coming up before the end of the month, and then the Fed is going to hike November 2nd. That is recipe, in my view, for another leg down. Now, the only way that I think we get sort of a choppy consolidation sideways, right, is if earnings come in as expected or better as a surprise, then we might stave off a violent rundown. I still think the Fed is going to hike by at least 75 November 2nd, and then we have the elections November 8th. And that might just give us like a brief pause or maybe choppy action if earnings come in as expected or better. But if earnings come in terrible, then the Fed hikes. We're going back to those pre-COVID highs pretty quickly, in my opinion. Let me take your questions. The last two recessions, 02 and 09, bottomed on average 43% below 200 EMA. You think we'll get there? Are you talking about 200 week or 200 day? Thanks for the heads up on opening a strangle 2 times in a row. I've made a couple decent plays from you. Appreciate you, Lewis. Yes. Increased the market printing. Yeah, for now, they're going to trap all the FOMO buyers for sure. I don't think that there's any reason to see a real rally here. Footy Gouda, how to join your Discord. Check the link in the description. There should be spots open for October. If they're not, then wait until November. But there should be spots open for October. But book a free call with one of our ambassadors. And you will gain access to the academy. You also gain access to the options course, day trading course, the Zoom calls with me. Oh, by the way, we are doing, you know what? Let me pull this up. We are doing a Zoom call on Saturday, this Saturday. Let me find the details for you. But we are doing a Zoom call this Saturday, and I'm actually opening up this Zoom call to the first few. I think it's capped at 1,000 people. So we're definitely at the point where, hold on. I think it's capped at 1,000 people because of the limits of Zoom. Plus, I don't want to make it, I don't want it to be overcrowded because I want to be able to answer people's questions. But so every month we do a Zoom call where users get to ask me, any question about trading, about options, about futures, about technical analysis, fundamental analysis, etc., how I'm investing, whatnot. And we go over, we talk for, supposed to go for an hour. We usually talk for 2 hours. And I go over everybody's questions, and we do live training, and go over some of the topics that you guys struggle with, as well as, pick up new tools such as futures trading or, some of the more complex option strategies. But that Zoom call, I'm opening it up for the first time to 1,000, capped at 1,000 people. I think I want to say it's either 500 or 1,000. I'm actually not sure how it was set up, but I'm going to put this link because I don't think it's in the description of the video. I think I forgot. So I'm going to put it. I'm gonna pin it to the first comment of this video after, and I'm gonna put it in the chat. I just put it in the chat. So if you want to be, part of the, I think either 500 or 1,000, I can't remember, click that link in the chat. And then we're going to be doing it this Saturday at, I believe, 9 a.m. Pacific time. So if you want to join, absolutely free, join that call. This is the first time that we've ever done that. So, and it's because people have been asking me about it, and I want to be able to give you guys a glimpse as to how these things are run. So, it's for anybody and everybody, but you'll see the link in the chat, and I will post it if you're watching this after. I will post it to the pinned comment of the video. So, um, Traveling Trader is a pretty cool guy, not afraid of the CPI. Yeah, I mean, because we're able to play these things. We're able to play these things pretty easily, I would say. Um, so yeah, World Series, Dodgers versus I don't know. I honestly don't know. The Dodgers didn't look good last night. I was actually at the game last night. We ended up losing 5-3 to the Padres. It was a really, really good game. But yeah. Are the Lakers making the playoffs? Nope. What do you think about WBA? The stock? What about it in terms of the chart or what? Remember horrible inflation 1982 and biggest rally in history began midsummer 1982. Yeah, let's look at those numbers actually. So in 1982, this is why we have data. As I said before, look at what the inflation was. Inflation was horrible relatively, 6.2%, right? But look where it came from. We had inflation at 13.3%, 13.5% in 1980. So imagine a scenario where CPI came in today at 6%, right? Or 7% even. It doesn't even have to be as low as 6%. Imagine it came in at 7%. The market would rally insanely if inflation came in at 7% today. So it's all relative. And 7% is not good. It's just better than where we were, which was at 9 and 8%. Inflation was 13.5% in 1980. So of course, in 1982, if inflation is now 6.2%, which is more than half down, then the market is going to rejoice because finally inflation was coming down. And guess what else was coming down? The Fed funds rate went from 15% in March to 8.5% by December. So the Fed was cutting rates and inflation was finally going down. Of course, that is a recipe for a rally, right? If you look at it on its face, I think the way that you framed it, with all due respect, is incorrect. Who was this that wrote that? Edward, my boy. If you look at this on its face, yeah, but when you start digging into the numbers, I think your view of this is incorrect. It's because inflation was coming down significantly. It was cut by more than half. It went from 13.5 to 6.2, and then the Fed went from 20% to eventually 8.5% by the end of that year. So the Fed was aggressively cutting as inflation was finally coming down. That's why we had an insane rally in 1982. So if the Fed now starts cutting and inflation is going down significantly, then yeah, the market is going to rally like crazy, of course. Does it still make sense to short futures here on Wahid says? If you're asking me that question, you probably shouldn't short futures, because you would have actually shorted it before today, not now. Now, does it make sense to short futures? Yeah, if you're looking at ES here and you're a very adept day trader, then yeah, you will know the points at which you need to short, right? You're going to wait for a break of market structure. You're going to wait for some sort of retracement up, and then short from that level. So yeah, if you're asking me whether you should short futures, I'm afraid it sounds like a general question, like whether you should just open a short on futures. And if you're asking me that, then you probably should be paper trading until you get your bearings under you and learn how to short intraday. But if you're asking whether you should just take a random short here, no, I mean, the market made a huge move today. the time to short was before, the optimal time to short was before today. Now, do I think that the market is going to come down to these pre-COVID levels? Yeah, I do think that's the case. If you shorted futures and we had a few up days, you're going to panic at the unrealized losses in your account. If you've never shorted futures before and seen how those futures react to a rally once you short them, then you're going to panic at the unrealized losses and you're not going to know how to maneuver. You're likely going to close your position for a loss because the loss will look so large. So no, I don't think you should randomly short from here. The time to short was yesterday. That was the optimal time to short. Not randomly today. Leaps. Long-term puts. Again, Marie, I think you're a little late here. Puts are going to be very expensive now because volatility is up and the market is down. So you're going to be paying the most for those puts. How about them Cowboys? Not a Cowboys fan. Actually, I haven't watched NFL in so long, but definitely not a Cowboys fan. Z looks a bit sleepy. Yes, it's. I woke up at 6 to do this live stream. I'm on the West Coast. You help a lot of people. Thank you, Z. Appreciate you. Great balance, cool and calm analyst. Appreciate you. Are you expecting gas prices to drop after midterms? I mean, this all depends on what goes on with OPEC. So OPEC, let's see. Let me pull up. I actually watched a hilarious interview yesterday with one of the ministers in Saudi Arabia, but I think it was on CNN, I think. But OPEC had cut supply, right? And they said that it was purely economic and it wasn't meant as a political move. And basically that it's in OPEC's best interest to make sure that oil prices are not erratic, which is what I think it was. Let me see. It was this interview here for those of you that are interested on watching it. It was on CNN. It was actually a really enlightening interview. I don't agree with what was said, but it was a very enlightening interview where the Minister of State of Foreign Affairs, Adel Al-Jubeir, was basically saying that the OPEC cuts were meant specifically as an economic tool and not as a political tool. However, and one of the things he cited was it's in OPEC's best interest to make sure that oil prices are not out of control and erratic. But when oil prices hit $130 a barrel, OPEC wasn't complaining, right? And I want to make it clear, OPEC is not only Saudi Arabia. I think there's 22 countries in OPEC plus, if I'm not mistaken. So, but they are the most powerful because they produce the most. But OPEC and OPEC plus wasn't complaining when oil was $131 a barrel, right? But now that oil prices have dropped since that high, crude oil prices have dropped 41%. So, of course, now they're going to cut oil production to try to push prices up because, they're not enjoying these insane gains that they were enjoying earlier in the year. But, it's funny that OPEC Plus didn't care about price stability when oil was at record highs. But do I think the price of gas will come down? It really depends on what happens here, right? The next OPEC meeting, if they come in and say, you know what, actually, we need to boost more to meet demand, then the price of gas will drop. Otherwise, and it's not just OPEC, by the way, guys. It's not just OPEC. I went over this in one of my last videos, I think like 3 videos ago. So if you want a whole breakdown on the geopolitical and the economic situation with regards to the price of oil, click on that. But, if you look at the earnings of ExxonMobil, These are record earnings, 115 billion in revenue, 4.2% EPS. If you compare that with all of their earnings before, and they were a mega cap company before, right? But the revenue and the earnings that they've seen this summer is unlike any other in history. And if you just go back to all of their earnings before and compare what's going on this year to then, you might say to yourself, well, yeah, of course, the price of oil is higher, so they have to charge more for gas, and that's why they have record revenues. No, focus on the earnings number. Remember, earnings is the money left over after you pay for all of your expenses, after cost of goods sold, after taxes, after everything, right? So sure, if the story was ExxonMobil and Chevron have to pay more for a barrel of oil, so that's why they're charging more for gas at the pump, you might on its face say to yourself, okay, that makes sense. But why are their profits up, right? This means they don't need to charge Americans that much at the gas station because they can charge less and still make a profit. These are record profits. So the last earnings per share came out before that, before the summer. Their last EPS came out at 1.2. Before that, it was at 2. Before that, it was at 1.5. All of a sudden, in July, their earnings are 4.2. This is twice as much, 3 times as much as they normally make, right? So not only are their revenues going up, which is, you might say to yourself, understandable because the price of oil is going up, but their earnings are going up, which means they're making more profit by charging more at the pump, which means they don't have to charge that much, right? If they had a fucking backbone. But I get it. It's a capitalist country. It's a capitalist economy. We don't have state-run oil companies here. The government has no say-so in how much Exxon and Chevron charge at the pump. And they're going to do what's in the best interest of their investors. I don't agree with it, but that's how the system is set up, right? So whether the price of gas comes down, it's all going to be based on demand. If Americans show companies like Chevron and Exxon that they are willing to pay that much for gas and demand hasn't dropped, then gas prices are going to stay where they're at, right? But if demand finally drops and we get what's called demand destruction in oil, then they're going to finally drop the price in order to keep demand up. But don't for once think that these oil companies, these American oil companies, have to charge this much for oil. They're making record profits. Their bottom line is increasing as well as their top line. In finance, we call the top line is what's referred to as revenues before you take out things like cost of goods sold and expenses and whatnot. And then the bottom line is after everything is paid off, how much is left over. So their bottom lines are up exponentially as well, which doesn't make sense. If you're following a false narrative that oil companies have to charge this much because the price of oil has gone up. No, they don't. And you just have to look at their earnings to see that, right? All right. I like to listen to Z at 1.5 times. I don't blame you. I talk slow. Yeah, I like to get these. I like to get these details out as precise as possible, and I like to talk about a lot of things. So, yeah, I don't blame you if you'd like to watch me on 1.5 times speed. That's fine. That's all fine by me. All right. Yeah, hit that like button. If you guys are watching this, hit that like button for sure. Meta already at 2018 low. Yeah, roll of the dice. I'm not a huge fan of Meta. Meta is, and I've said this for most of this year. I did think that there was a price at which Meta presented a bargain. However, the growth story has been stripped out of Meta. Meta is now trading like a value stock, right? Because they are not able to show the market that that they have a growth story, that they have any sort of services or products in the pipeline that will turn them back into a growth company, a company that where like a traditional mega cap tech company like Apple or Microsoft, they're expected to grow every single year. And that's why they keep making investments and buyouts and creating services that allow them to grow, right? Whether it's diving into new businesses or creating new products like Apple that allow them to continue to grow. Meta is no longer a growth company. Meta is an advertising company with solid revenues, right? There still aren't very many companies on planet Earth that can pull in $30 billion quarters. But their advertising business is stale. It's a cash generating machine, so it's going to keep bringing in those revenues, but it's not there's no growth story there, right? And it's clear that the market doesn't give a shit about the metaverse. One, it can't even explain the metaverse properly. Two, there are no signs that the metaverse is a growth story. There's no signs whatsoever. So the market is going to keep dropping Meta's valuation until Meta can prove once again that it is a growth stock. Otherwise, I think Meta should start paying a dividend if it's going to see itself as a value stock, right? And once it does that, then it might attract more investors. But right now, Meta is not growing. That shit is dead on arrival. Yes, Omar, for sure. All right, you mean high enough? There's still mad traffic where I live, so gas prices ain't low enough. Yeah, I mean, that's anecdotal, but sure. Gallon of gas in Massachusetts is $3.45. I mean, it's all dependent on where you live, right? People in California drive more, they make more. So even though Massachusetts is a high earning state, it really depends on demand, right? That's all it's based on. It's just supply and demand. Do you think metaverse is too far off in the future? Yeah, not only is it too far off in the future, it's an unexplainable story at the moment. So for sure. Please keep this PZ, Rena says, or Ren. It's either Reina or Rena. Sorry for mispronouncing your name, but I appreciate you. Yeah. I talk slow because I like to dive into details. Other than stocks and trading, what other things should we be doing financially? Dave Ramsey states 6 months of emergency fund. Should we increase that to 12 months? One, you know me. I mean, I'm not going to give, there isn't a solution for everyone's situation. Everyone has a different need, right? But yes, I do agree with those analysts and money managers that say that during a recession, you want to increase cash reserves. That is for sure. You want to increase cash reserves because you never know what the situation, how long the situation is going to take. As I showed here, not only do you need to increase cash reserves because cash is actually less powerful because of inflation, but we don't know what kind of landing we're going to get, right? As I showed here, I mean, inflation stuck around for 2 years before it finally went down to single digits again between 1980 and 1982. So, if we're expecting inflation to be sticky and for it to cause havoc as it relates to rate hikes, then yeah. But I do think that if you look here at bond yields, it's so funny to me because the bond market is much bigger than the stock market, right? But when I say that, I always get sort of these looks of disbelief from my audience because nobody knows how to buy a bond, right? Now, bond investors are usually institutions, governments. Here's the thing, and I can't remember who I heard say this, but once you make a ton of money, it's so easy to keep it, right? When you start, it's getting to that level that's difficult. It's climbing the ladder, or what they call what is the word that I'm looking for? Upward mobility, right? It's upward mobility that's virtually impossible, meaning changing your your class, when we refer to economic classes as middle class, upper class, etc., changing your class in this country is nearly impossible to do on an en masse basis, right? You're always going to find people with beautiful rags to riches stories or whatnot. But usually the class that you're born into is the class that you're going to remain in for the rest of your life, right? Unless you are actively pursuing, somehow given the means to actively pursue the next class level up. So upward mobility is almost impossible in this country, right? And almost impossible anywhere, not just this country. Almost impossible anywhere. But once you get to that level where you're making a ton of money, keeping that money is very easy. So that is why the average investor or the average retail trader, whether you're lower class, middle class, and by the way, I hate talking about these classes. I'm just talking about economic classes. This has nothing to do with the quality of a person, right? To me, this is a finance channel, so this is why I'm talking about this stuff. This is not how I think of the world at all, by the way. But once you get to an upper economic class, it's very easy to keep that money, because now you could do things like sell options, for instance, right? You can now sell puts and sell calls with ease. You can also invest in treasuries, which is something that most retail traders don't even know how to do, right? But imagine you had $1 billion or $500 million or even $1 million, right? You like this 4.5% on your money looks really good because you're able to make a high yield because you have a large, you're able to make a high nominal dollar amount because you have a large starting dollar amount. But for someone that's looking to change their economic status, and for those looking to build wealth who don't have it yet, investing in treasuries looks paltry, right? Investing in the stock market, which is a much riskier asset class. And by the way, hit that thumbs up for those of you that are watching this. Just click on that little thumbs up. Do me a favor. Thank you. It's a much the stock market is a much riskier asset class. So, something that gains an average of 12% a year, like the S&P 500, 10 to 12% a year, looks a lot better for those that are trying to to build wealth than something that's going to pay you, a paltry yield. Now because the rates, the Fed funds rate was basically at zero for the longest time, yields were unattractive, right? But now that we're on the verge of a recession and we have crazy inflation, yields are going up. Now, what makes yields go up? Let me actually pull this out. What makes yields go up? It's when bond values go down. Remember, there's an inverse relationship between bond yield and bond price. And what makes bond yields go down is when people are selling their bonds or not buying bonds. Then the bond market increases the yield in order to make it more attractive for investors to pour in. So the more that people don't buy bonds, the more that these yields go up. The more people that sell their bonds, the more that these yields go up. Now, why do people sell bonds? They sell bonds out of fear, right? Why would you want your money locked up at 4% when you know that inflation is going up, or when you know that the Fed is going to increase their rates and these yields are likely to go up even further after the Fed hikes? So because we're very close to a Fed rate hiking cycle, and because the inflation numbers came in higher than expected today, that you can see bond yields surging now, right? Just surging. So all that is to say, to answer Omar's question about, different kinds of investments, the bond yields right now are looking attractive. So you can't find a savings account on earth that is going to pay you 4.43% to put your money in there for a year. But you could buy a year treasury and get 4.4%. You could buy a 6-month treasury and get 4.3%. Now, a lot of people say, well, if inflation is 8%, what am I going to do with 4.4%? True, True. But what else are you going to do? Right? So if you're not putting it in the stock market, which is a risky asset class that looks like it's still has a lot more left to drop, and you're not putting it in crypto or whatever other risky asset class, if you're not buying real estate, right? Where else are you going to put your money? If your money's just sitting in a bank and you have more than enough in terms of an emergency fund, what else are you going to do with your money? Would you rather lose 8% or would you rather lose, 3.6% on your money? We're talking about inflation here. So for those that do have enough liquidity, this is where bonds start becoming attractive, right? Um, but yeah, it's tough out there for sure. And most people don't know how to invest in bonds. And by the way, if you guys don't know how to invest in bonds and treasuries, if you're a member of a brokerage like TD Ameritrade or Schwab, you can call them anytime you want and it's free. So call them, they will walk you through on their platform how to invest in treasuries. You can also go to treasurydirect.gov, which is part of it's a government website, and it will show you how to buy treasuries, right? I'll show you how to buy treasuries and bonds. And by the way, this is the last month that you can get 9.62% on a Series I savings bond. So you might want to take advantage of this because the rate is going to change on October 28th, I believe. The rate will change, and the rate is set to drop to 6%, 6-ish%. So this is the last time that you can get 9.62% guaranteed from the government. Now, this comes with a limit of $10,000 per account, and you can open up an account for every dependent that you have, right? So if you're a family of 4, you can open up one for yourself and 3 more for each of your dependents. And you will gain 9.62% annual yield, but this will now only be good for the next 6 months guaranteed. And then on October 28th, the new rates will come out for the 6 months following those 6 months. And it's likely to be 6-ish%, which is still great, but it is capped at 10,000 per dependent. So anyway, long-winded way of saying that. All right, Series I bond a good idea? Yeah, I was just talking about that. Is it easy to sell bonds back at any time? Yes, you could sell bonds at any time, but each bond and treasury has a different, I guess what you would call vesting conditions, right? Like when you are owed the interest, how long you have to hold it for. If you sell it early, are there any penalties, etc. So yeah. SOXL dead. Yeah, I mean it's a leveraged ETF for sure, but it's not going to be for in the long term. But yeah, I like your quote about people's class. Appreciate you, Mobeen. What are your thoughts on going long on TLT? There is going to be a time to go long on bond ETFs. For me, it's not now. Are you shorting bonds right now? Right now, I am shorting the 2-year through futures, right? And I opened that up, I want to say last week. But remember, when bond yields go up, bond prices go down. So shorting bonds, you're shorting the price of bonds. You're not shorting the yield, right? So when you're shorting a bond, you're expecting the yield to go up. So I shorted the 2-year. The 2-year is the most sensitive to Fed policy, right? Because the Fed policy affects short-term rates. So the 2-year is the benchmark as it relates to Fed policy. But yes, I shorted the 2-year through futures. The great Benny Boy. I heard something about a free coaching call this weekend. Super excited about that. I posted a link up top, and there will be a link as a pinned comment to this after it's done. But yeah, scroll up in the chat and you'll see it. All right, guys. Any last minute questions before I sign off? And hit that thumbs up on your way out, by the way. I'm so bad at saying that. Any last minute questions? Do you see any zombie companies like AMC, GameStop going bankrupt? I don't know, honestly. Due to the rate hikes, maybe. Yeah, I don't know what their positions are, honestly. Um, are you looking for any pop up to push lower or just more? Any pop up to push lower? Not sure what you're talking about. Thoughts on AMC? Thoughts and prayers? Ask a more specific question. Good time for cash secure puts. If you are okay with the prices that you are getting now, on those stocks, and you're okay being assigned at those prices, sure. When the market starts tanking, that's when you want to sell cash secure puts because you get the most for your money. All right, guys, I'm about to end the stream. Let me know. Yeah, hit that thumbs up on your way out. Leave it in the comment section below. Let me know what you think of the inflation, what you think of the Fed rate hikes, what stocks you are buying, if you are ever. Do you think AMC would ever return back to highs in this market? I mean, it's a meme stock. It depends on what the memers want to do with it. But no, I don't know how many people are holding their positions. So yeah, I think the hype, I think that hype train is over, because when I say over, it will have major pops and drops for sure. But the time that AMC was going crazy, there was record option buying that we're just not seeing now. I think a lot of people exited the market. Do you still expect market rally like last time when Jay Powell speaks? Yeah, of course. But only as a day trade. Do you see any retracements up? Any? Yeah, I mean, of course. What kind of question is that? Of course. Any? Yes, there will be a few retracements up, and there will be pops back down. I mean, drops back down. Yeah. Nothing goes down in a straight line. Point me to something that goes down in a straight line. Eric K, I'm holding. Not sure what you're referring to. AMC? Yeah, maybe you are, but for sure a lot of people have exited the market. And we were seeing insane option buying, which was driving, gamma up. It was a good question. No, I mean, Jay, it's not a specific question. Honestly, like, of course we're going to see retracements up. Like what goes down in a straight line? Like, even, go back to the COVID crash of 2008, like, you're going to see these pops up like this, right? You're going to see green pops up on the way down. We see, like, the market has been steadily going down since January, right? But you see very violent bear market rallies. So if you're asking whether we're going to see any, yeah, of course you are. But that's the case. Warriors or Lakers on opening night? Probably Warriors. All right. Hey, that 9%. Yeah, if you're talking about the I bond, yeah, I think it's going to only be good until November. All right. Thank you guys for joining so much. Thank you for your questions. Hit that thumbs up on your way out. If you have any more questions, I'll catch the rest of you on the Discord. Look out for that Zoom call I'm going to be opening up to everybody. Look out for that on Saturday. Link is up in the chat. I will also be putting it in the pinned comment of this of this video. Yeah, I'm super tired. I need more coffee. But thank you guys for joining. Stay safe out there, traders. Peace.